Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and crystal ball gazing. Today is Tuesday, November 26, 2024. Today's episode, we are going to start. Before I get into today's episode, remember today's a holiday week. It means the professionals are home, so you got to take a lot of what happens in markets with a pretty big grain of salt, including, for example, how yesterday the 2-year, 10-year treasury yields re-inverted, and then today we are uninverted again. It is interesting, notable how we're sort of sitting very close to zero, bumping along, not getting steeper in the curve yet. It'll come. It has to come eventually because of the fact that, at the end of the day, when you lend your money for a longer period of time, you expect a higher rate of return. And for there to still be a higher rate of return on the front end of the curve, it will resolve itself eventually. It's just a matter of when. And it is still extremely disconcerting that, the 3-month tenure has been inverted for, it's going to be 2.5 years pretty soon, which is, it's a scary metric. Anyway, to get through the main points of the episode, first thing that caught my eye today was that inflation priced is dropping. The market prices inflation. As much as you hear on the media or other YouTubers talking about inflation is going to do this or that, there's a market that actually predicts that and prices it. People are betting on it with money, which, if you know anything about markets, they're pretty good at detecting changes in where things might go. When people have their money at stake, they want to know what the odds are. And those odds are priced into the 10-year break-even inflation rate, notably for since November 7th, since the beginning of the month. This is practically 3 weeks. We've been just going abnormally sideways from this point, November 7th, just completely sideways. And I've been talking about this on the show, how unusual it was for us to be going sideways for this long. And the longer we go sideways, the bigger the breakout. And the breakout was to the downside, and we had confirmation going even lower on the 10-year break-even inflation rate today, predicting 2.28%. This is trending lower, as I have been expecting, as I saw in my crystal ball with my daily reminders and everything. For people to say, well, it's okay to invest in stocks at historically expensive levels compared to the, for the CAPE ratio being at 38, the PE ratio being at 31, because inflation is going to be high, and so it's going to protect you because everything's going to go up. Well, right now, inflation is being bet on to go lower, trending lower as it stands. Something to keep a close eye on that chart. Next thing for today's episode, initial jobless claims and PCE data come out Wednesday. Normally, initial jobless claims for the previous week comes out on Thursdays, but we have a holiday this week, so it's coming out a day early. It has a potential to be a black swan event any possible week, so it's one of the things to keep an eye on. Even though it's a holiday week, if some crazy data comes out, things could blow up during this week for sure. It's possible. Moving on, the daily reminders. Nothing has changed. If you want to see me walk through the daily reminders, watch Monday's show. That would be November 25th, 11:25. It has a picture of a tree with lightning striking it. These are very important things for any active investor to be highly aware of. Watch Monday's show to hear me read through them. I do it every Monday. With no updates in the daily reminders, the crystal ball readings remain that the S&P 500 is currently priced like it's a Ponzi scheme, relying only on the price to go higher, or relying on others to pay more tomorrow for the price you paid today instead of any kind of safe valuation. Benjamin Graham would not consider the current valuation of the S&P 500 to be safe at all. He would be running away screaming. This suggests that there is a bear market imminent. This part of the reading includes the fact that we've recently started the cutting cycle and that there have been developing chart patterns in, crystal ball readings wise that suggest that this may be coming imminently at this point. We're kind of just waiting for the last straw to break the camel's back, the black swan to appear. It's like clear that it's going to come. But we're still waiting for it. And then the last crystal ball reading hasn't changed either, that the Fed won't cut fast enough to save the economy. And if they try to cut, even if they slam rates all the way to zero, it won't necessarily be enough to save the economy, because of the fact that when a country, when a society, when a world has an enormous amount of fiscal debt, monetary policy is less effective. And so those cuts are not going to boost things and get things going as much as the Fed might hope. Moving on to the charts, the S&P 500 hitting the all-time high, functioning basically as a double top. I mentioned yesterday this could function as a doji to be a reversal candle to the downside. Instead, we popped up and we're retesting all-time highs. Again, on holiday weeks, like other very good traders note, the bias is neutral to positive, and so for things to float up is not to be something that's surprising, not at all. When the cats are away, the mice will play. No matter how high valuations can get, especially, that's where we are. Bitcoin continuing to go down here. When it comes to a chart pattern, this does not look like a bull flag. If you wanted a bull flag, you would want it to stay within a range here, going back and forth, and then eventually breaking out to the upside. Instead, we have a curving looking thing going downwards, and so we do have obviously some support at this level, and so this could serve as support to the leg next higher. I really don't know. Again, I'm not participating in this market at all, but it's fascinating to watch. Oil, an international market that, the cats are away, sort of. The rest of the world's markets are open, though, which includes the value of the dollar and oil. And so oil is one of these markets to take a little more seriously during this week. And it is continuing to show a little bit of weakness here. Again, knocking on this previous trend line door to the downside. This is part of one of my reasons for believing that there's a bear market imminent, because when oil cracks to the downside, that's when you get that very clear disinflation, deflation mode where everything drops in price, and you get a recession, you get a depression, and all of the lovely things that come with it. Gold, after dropping 3.34% yesterday, forming so far what looks like a bear flag on, from one day to the next. And so the expected move would be further a weakness here. Additionally, we have a lower high, lower low, a lower high. And as long as that pattern is intact, my crystal ball says that gold is bearish at this moment. Next, we have copper. Copper doing a similar thing to gold. We have this drop. We have this bear-looking flag thing. And this is right on this line of another head and shoulders top-looking thing. It almost looks like this is set to break down imminently. And when it does, that, professional traders, they're going to go short here. They're going to go short aggressively. This is a pretty clear pattern set up in copper, in the copper market. As bearish as I am on markets in general, not all markets seem so overvalued and ridiculous. Some of them seem actually obscenely undervalued, including this fund, REMX, the VanEck Rare Earth and Strategic Metals ETF. I point this out because we are at this trend line here, this bottom here, bumping along it today. Again, if you scroll out on the value of these companies that produce rare earth and strategic metals, including lithium, cobalt, things that are involved with batteries and magnets and fancy electronics. The value of this entire fund in 2011 was at $229, currently at $45. This is an attractive place. This is one of these areas that's clearly under invested in for a long time. I mean, 2011 was 13 years ago. You know, investors investing in 2011 in these companies are still sitting on massive losses, either, you know, still selling regrettably. You know, once we run out of sellers and people realize that these companies actually do produce valuable things for the world, there's a lot of upside potential in this market. That's all I gotta say. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.